We are looking at Western Digital today, and the stock just went absolutely vertical.
Oh yeah, up 15% in a single day.
Right, trading right at $533.04. And if you zoom out to look at the past 12 months, the stock is up over 550%.
Which is just a violent, fascinating market story. Especially because, in the middle of this massive AI chip arms race, the most desperate supply shortage in Silicon Valley isn't actually for neural processors.
No, it's for spinning metal disks, which, I mean, most people thought went obsolete a decade ago.
It's a total paradox. Everyone pictures the future of AI as these sleek silicon wafers powering autonomous networks. Nobody is picturing the bulky mechanical hard drives you'd pull out of a dusty server rack from 2010.
But here we are in July 2026, and the market is fundamentally losing its mind over exactly that technology. Welcome to Market Pulse Daily. I'm your host, and our mission today is to figure out the underlying mechanics here.
Right, trying to see if Western Digital is just riding a fleeting hype cycle, or if they're entering a multi-year AI supercycle.
Exactly. But before we get into the fundamental catalysts, just a quick reminder that today's show is brought to you by StockOracle.
Yep, StockOracle is an AI-aided stock research platform for fundamentals, valuation estimates, moat analysis, bull and bear insights, comparisons, watch lists, and portfolio research.
It's a great tool, and there's a special 14-day trial link below in the description. We won't read the whole URL here, but just click the link down there.
And we should mention that it's an affiliate link, so the channel may earn a commission at no extra cost to you.
But please remember, StockOracle is not financial advice, it is not a buy or sell recommendation, and it's not a trading signal service or real-time market data.
Right. AI insights and valuation estimates can be incomplete or wrong, and the data might be delayed.
Yeah.
Always verify important facts yourself.
Okay, so getting into the actual fundamental catalysts. To understand today's 15% price spike, we first have to look backward at how Western Digital drastically transformed their business.
Yeah, the Western Digital seeing this massive surge is a fundamentally different company than it was just 2 years ago.
Because in early 2025, they executed this massive strategic shift by spinning off their SanDisk flash memory business.
Oh, it was huge.
It's, think of it like a marathon runner who just dropped a really heavy backpack so they could sprint faster. They basically became a streamlined, pure-play leader in high-capacity hard disk drives.
And that pure play focus fundamentally rewired their financials. When you look at their fiscal third quarter 2026 numbers, the results are they're difficult to process for a legacy hardware manufacturer.
They pulled in $3.34 billion in revenue.
Up 45% year over year.
Right, and their non-GAAP earnings per share came in at $2.72. That completely destroyed analyst estimates.
But the real story is the unit economics.
Yeah.
That is the engine driving this entire 550% run.
Yeah, the average selling price for a terabyte of their storage went up by 9%.
While at the exact same time, the cost to physically produce that terabyte fell by about 10% annually.
Wait, really? Their costs actually dropped that much?
Yeah, because as their manufacturing processes for these ultra-dense drives mature, their factory yields improve. They throw away fewer defective disks.
Oh, that makes sense.
So when your selling price is dictated by desperate buyers and your internal costs are plummeting, your margins expand rapidly. We are seeing incremental gross margins hitting 70 to 75%.
Okay, this is where I need you to explain something, because they just crossed a 50% gross margin across their entire business for the first time in their history. How rare is that? I mean, for a hardware manufacturer to have software-like margins.
Historically, it's an anomaly. It almost never happens. Hardware companies operate in the physical realm. They have to mine raw materials, manage complex global supply chains, run massive fabrication plants.
And physically ship heavy metal boxes across the ocean.
Exactly. Because of all that overhead, a great day for hardware margins is usually somewhere in the 20 to 30% range. Software boasts 70 or 80% margins because replicating a line of code costs practically nothing.
So for a company building physical metal drives to break 50%.
It signals a severe structural imbalance between supply and demand. Buyers have absolutely zero leverage right now. They're willing to pay whatever premium Western Digital asks for just to secure the physical drives.
Total pricing power.
Total pricing power.
And you can see that leverage on their balance sheet, too. Their debt-to-equity ratio is essentially non-existent, just 0.01.
Practically zero debt dragging them down.
And they just authorized a massive $4 billion share repurchase program. So mechanically, what does a buyback of that size tell us about the company's internal mindset?
Well, a share repurchase program is the ultimate indicator of management's conviction. When a company buys back its own shares and retires them, it reduces the total number of shares available, making every remaining share intrinsically more valuable.
Right.
But the timing is the key part. Management is looking at their internal projections and deciding that even after the stock has run up 550%, buying their own shares is still the most lucrative place to deploy $4 billion.
Wow. That level of confidence demands a look at the actual customers. We hear endlessly about the AI chips, the processors training massive language models, but those processors are useless without data.
Exactly. An AI model requires training data sets of a magnitude humanity has never dealt with before. We aren't talking about text files anymore. We are talking about ingesting millions of hours of high-definition video, global satellite imagery.
Real-time sensor data from autonomous vehicles.
All of it. And all that digital information requires physical real estate.
Hmm.
It has to be stored on a disk somewhere in a data center.
Now, a lot of people might assume that solid-state drives, SSDs, would be the obvious choice since they are the newer, faster tech. But I like to think of it this way. SSDs are like high-end sports cars. They are incredibly fast, highly engineered, and very expensive.
Perfect for the immediate active processing of AI.
Right, where speed is all that matters.
Yeah.
But hard disk drives, the HDDs, those are the massive cargo ships.
And you cannot run a global supply chain using only sports cars. The sheer volume of data required for AI creates massive data lakes of what the industry calls cold storage.
Data that needs to be kept but isn't being actively processed every single millisecond.
Exactly. The total cost of ownership to store exabytes of data on solid-state drives would instantly bankrupt even the largest tech companies. Hard disk drives provide the vast, cheap cargo space required to actually make the economics of AI feasible.
And we are seeing the hyperscalers act on this. They are locking in Western Digital for years in advance. I mean, they are signing multi-year purchasing agreements extending all the way out to 2028 and 2029.
Which fundamentally alters how Wall Street values a company. Usually, the hardware sector has to hustle for every new sale, quarter after quarter. But Western Digital has effectively guaranteed their revenue pipeline for the next 4 years.
Because the AI hyperscalers are terrified of a storage bottleneck.
They are hoarding future production capacity today.
Which brings us to the technology they are actually rolling out to meet that demand. Right now, their flagship 40-terabyte Ultra SMR drive is in qualification with hyperscalers. Volume production is expected late this year.
And just for context, Ultra SMR stands for shingled magnetic recording. Instead of laying data tracks side by side, they overlap them slightly, like shingles on a roof.
Oh, to squeeze in more data per square inch.
Exactly. But the real technological leap happens in 2027 with the transition to AMR technology, heat-assisted magnetic recording.
The physics of this are just staggering to me.
It really is. To pack data even more densely, the magnetic bits on the disk have to be incredibly small, which actually makes them unstable. So AMR solves this by attaching a microscopic laser to the drive's writing head.
Wait, a microscopic laser?
Yeah, it heats the exact spot on the disk for a nanosecond, allowing the data to be written securely, and then it instantly cools and stabilizes.
Using microscopic lasers to squeeze 100 terabytes onto a single drive by 2029 sounds like science fiction.
It does, but even if they pull it off flawlessly, the macro data suggests it still won't be enough. Morgan Stanley recently published an analysis projecting that in calendar year 2026, the global supply of hard disk drives is going to fall 10 to 15% short of demand.
Because AI storage consumption is growing at, what, 40 to 50% annually?
Yeah, while the physical capacity to manufacture these drives is only growing at 30 to 35%, the math inevitably leads to a massive, prolonged supply crunch.
Which brings us directly to the market sentiment today. I mean, that 15% explosion at the opening bell. What was the specific catalyst that triggered such a violent move today?
The catalyst actually came from Western Digital's customers. Tech giants, notably Amazon and Apple, recently released statements flagging continued aggressive price hikes in memory components. They were explicitly warning their own investors about severe supply crunches.
So when the most powerful companies on Earth publicly state we cannot source enough storage and we are forced to pay a massive premium, Wall Street immediately adjusts its models.
Exactly. It perfectly aligns with the reports that Western Digital's nearline HDD business is completely sold out through the rest of fiscal year 2026.
And just to clarify for everyone, Nearline drives are those massive, high-capacity disks data centers use to keep data accessible just a fraction of a second slower than their primary servers.
Right. So being entirely sold out of your core enterprise product while prices are actively rising.
It forces analysts into a bidding war with their own financial models.
And we are seeing that bidding war in real time. Morgan Stanley lifted their target to $650. Citi raised to $685, then immediately revised it again to $800.
And Cantor Fitzgerald's projecting a $900 share price. They are pricing in a reality where the AI infrastructure build-out just doesn't slow down for the rest of the decade.
But getting to these valuations has not been a smooth ride. The stock carries a beta of 2.245.
Which means it swings wildly. A beta over 2 means Western Digital is more than twice as volatile as the S&P 500. But wait, if they are practically printing money with 50% margins and locked-in contracts until 2029, why did the stock just tank 17% over 5 days last week before today's massive gap up?
Well, the market is always trying to price in future risks before they happen. Even a minor rumor about a supply chain delay can trigger automated selling algorithms.
Oh, leading to those brutal 17% pullbacks.
Right. It shakes out the weak hands before the fundamental data, like today's pricing catalyst, forces the stock back up.
Okay, I have to push back a bit on the whole conviction story, though, because when you look at the market sentiment regarding insider trading, over the last 90 days, company insiders have sold over 61,000 net shares.
That is true.
We are seeing 111 sell orders compared to just 29 buys. I'm having a hard time buying the standard routine profit-taking excuse. If executives actually believe this thing is going to $900 by 2029, why are they rushing for the exits now?
I get why it looks alarming, but you really have to view those numbers against the scale of the enterprise. Western Digital is a $150 billion market cap company. In the context of their total outstanding shares, 61,000 shares is a statistical rounding error.
So you don't view that ratio of 111 sell orders to 29 buys as a red flag?
I don't. You have to consider how executive compensation works. The vast majority of a tech executive's wealth is tied up in stock options. When your company's stock surges 550% in a year, your personal portfolio just quintupled.
Right.
Selling a fraction of those shares to diversify your assets or pay taxes is just standard financial planning. The overwhelming majority of their net worth remains tethered to the successful rollout of that AKMR technology.
Okay, that contextualizes the insider selling, but it opens the door to a much-needed reality check. We need to look at the pros versus the cons. No stock goes up in a straight line forever, and when a company is up 550%, the downside risks are magnified.
Oh, absolutely.
So let's stress test this multi-year holding thesis and dig into the bear case.
The primary argument against the stock right now centers squarely on valuation risk. Western Digital is currently trading at a price-to-sales ratio of 12.77 and a price-to-book ratio of 15.53.
Which means investors are paying almost $13 for every single dollar of sales the company generates, and over $15 for every dollar of physical assets they own on paper.
Right, and in the hardware sector, those multiples are astronomical. It speaks to a very dangerous investor psychology where the stock is currently priced for perfection.
Everything has to go right. The 40 terabyte qualification, the 2027 HMR rollout, maintaining those 50% margins.
All of it has to happen exactly on schedule. If a single microscopic laser component in the HMR drive fails qualification and delays volume production by even 1/4, the stock will crater because years of flawless future execution are already baked into today's price tag.
And operating flawlessly is tough when your primary rival is actively trying to destroy your market share. We have to talk about Seagate.
Yes. Seagate is not sitting idly by. Their Mosaic drives are already hitting 44 terabytes in testing, and much like Western Digital, Seagate is reporting that their nearline supply is completely sold out through 2028.
So they're running completely neck and neck in this arms race.
They are, which makes 2027 the critical inflection point. That is the year Western Digital must successfully transition to HNR technology at scale.
And transitioning a massive global manufacturing apparatus to a fundamentally new way of recording data using lasers involves incredibly complex physics.
Extremely delicate fabrication processes. If Western Digital faces yield issues, meaning too many of the new HAMR drives fail quality control, Seagate will instantly step in to fulfill those massive hyperscaler contracts.
And at a 12.77 price-to-sales multiple, Western Digital literally cannot afford a single manufacturing stumble.
Not one. But zooming out even further, the existential threat isn't just Seagate, it's the cyclicality of the memory and storage industry itself.
Right. It is notoriously built on boom and bust cycles. Right now, we are in the mother of all booms, driven by generative AI. But how does the bust actually happen mechanically?
Well, the market is currently assuming the AI infrastructure build-out is a permanent, uninterrupted upward curve. But what happens if 2 years from now, these massive cloud providers decide their current data center capacity is sufficient for the next generation of AI models?
You trigger a brutal destocking cycle.
Exactly. The hyperscalers simply stop placing new orders.
Mm.
Suddenly, Western Digital's multi-year contracts face renegotiation pressures. Inventory begins piling up in warehouses.
And when inventory piles up, pricing power vanishes. Western Digital and Seagate are forced into a price war to clear out their surplus drives.
The average selling price plummets, unit costs rise because factories aren't running at full capacity, and those software like 75% incremental margins violently unwind.
It's an incredible high wire act.
It is, but the data shows that right now, they are executing it flawlessly.
So, bringing this all together for our final outlook today, the narrative is pretty clear. Western Digital has brilliantly positioned itself as an indispensable, pure-play infrastructure provider for the AI boom.
Yeah, by shedding the weight of their flash business, they focused entirely on becoming the undisputed architects of the cargo ships of the AI era.
The financials definitely validate the strategy. 50% margins, multi-year agreements locking in revenue out to 2029, and massive tailwinds with AI storage demand outstripping global supply.
It is why analysts give them a bullish 8 out of 10 score and why price targets are creeping toward $900.
However, as an investor, you have to stomach extreme volatility, a beta over 2.2, a stock price for absolute perfection, and relentless competition from Seagate.
The 2027 rollout of AMR technology is the definitive milestone. They have to hit it perfectly, and they have to hope the AI spending spree doesn't suddenly catch its breath.
It is a delicate balance of massive potential reward against significant execution risk, which leaves us with a final provocative thought I want you to mull over today. It's a concept known in computer science as data gravity.
It's a fascinating concept.
Think about the exact moment we are in right now. AI models are transitioning out of their training phases in isolated research labs, and they are now being deployed in the inference phase, being used by billions of people every day.
And during that inference phase, they don't just consume data, they create it.
Right. They are generating novel synthetic data constantly. AI-generated text, photorealistic images, millions of lines of code. Analysts project that AI systems will generate more novel data in the next 2 years than in all of previous human history combined.
The sheer volume of that is just difficult to even conceptualize.
It really is. So here's the question to ponder on your own. Even with 100-terabyte laser-heated hard drives coming in 2029, are we fundamentally underestimating the physical reality of our digital future?
The raw materials, the real estate for data centers, the massive energy grids.
Exactly. Are we vastly underestimating what it will actually cost to store the memories of an AI-driven world? Because if the data tells us anything today, it's that this invisible digital mind is going to take up a massive amount of physical space.
That's a great point to leave off on.
Well, that wraps up today's analysis. Before you go, remember to check out the special 14-day trial link for StockOracle in the description below.
And again, it's an affiliate link, so you're helping out the channel at no extra cost to you.
StockOracle is fantastic for checking out fundamentals, valuation estimates, and portfolio research. Just remember, it is not financial advice or a trading signal service. Always verify important facts yourself because AI insights and data can sometimes be delayed or incomplete.
Absolutely.
Thanks for tuning in to Market Pulse Daily. Don't forget to hit subscribe, and we'll catch you next time with more market insights.